Hello traders, Gary Wagner here, just about 1 o'clock in Honolulu, 7 o'clock in New York. It is Thursday, first day of October 2020, and this is the Daily Report for Gold and Silver. With the anticipation of a possible stimulus package, or aid package I should say, mulling through both the U.S. Treasury Department and the Congress, that optimism really moved gold to the upside. It wasn't so much dollar weakness, although there was some dollar weakness, but today's $20 gain in spot, $17 gain in futures was all driven by market sentiment, which has turned extremely bullish over this last week. We'll take a look at that, talk about our current trade when we look at our charts, but first to the price board. Market sentiment has surely shifted this week, moving back into the bullish mode. We had gains across the board in the precious metals complex, with the exception of platinum, which lost about 0.2%. The smallest percentage gain on the day was palladium. We have palladium up about $2.90, still king of the hill in terms of pricing at $2,333.40. Silver had a very nice gain today of about 1.81% or 42 cents and is currently at $23.92, pretty much where we entered our silver futures trade at. Gold, however, had a nice gain of almost a full percentage point. We're in at 1890. Market closed at 1911.70 after factoring in today's gain of $16.20. Forex traders saw a very nice gain also, 1905.60. That's up $20.27, putting both spot and gold futures positions that we have recommended into profits, at least for the day. When we look at SLV, that did gain about 2%, and a share is going for $22.09. And gold GLD gained about 0.9% and is currently fixed at $178.70 per share. Lastly, this was accomplished with some mild tailwinds from dollar weakness, but they were nominal. The dollar was up just a little over 0.1% at 93.81. One thing that I can say for certain is that this week and the last couple of days of last week, we have seen trading action turn decisively bullish from that of a bearish demeanor. We're looking at a daily chart of gold, this of course in candlestick format. We identified a pattern called a pennant formation, and we spoke about the fact that when it hits the apex, we would see a release of energy. I was absolutely correct about that, and as I said yesterday, I was 100% wrong about which way we would see the break go, because typically the market will move to the overall trend direction. And in this case, it was counter to that. So we saw the market really go from about 1960 down to about 1850, 1847, that's right here. But then on Friday, as well as Thursday of last week, we got our first signs of bottoming. And I really felt strongly about the potential for a V recovery for two technical reasons. We had absolute confluence with the Fibonacci retracement and the 50-day moving average, as well as the 38% Fibonacci retracement and the 100-day moving average. And the fact of the matter is, once the market did excel and break above that particular resistance point, we saw it challenge it throughout August as it would dip below that price point, but for the most part close above it. That changed when we hit the apex. That took gold pricing roughly $80 to $100 lower. I can certainly say at this point that what we are witnessing is a standard V recovery. We had a sharp sell-off, price decline. It found technical support at this particular level, of course, which is 1844 and 1847. That is the price of the 100-day moving average back then, and it is also the 38% retracement level. Now, with the move that we have seen this week, the 100-day has now gone up a little bit to about 1858, and the 50-day is at 1951. So, what are we looking at in terms of where gold could head? Well, I see two potential areas where we could find resistance. We're not there yet, but the one level that is not based upon A moving average or a Fibonacci retracement is simply looking at various tops and bottoms in the market that occurred and whether or not that bottom or top was significant. In the case of the price point at 1920, it is extremely significant. The reason I say that is that was the record multi-year high, and we witnessed a multi-year correction following the move to that particular price point. If you recall, for approximately the first 2.5 years, we saw gold pricing trade between 1800 and 1537. It then eventually broke below that, and it took till the end of 2015, beginning of 2016 to hit a bottom. That was at around 1040, and that was really the beginning of a new bull market, something we hadn't seen in many years. So as we look at current pricing, it is the reason that I think that we could see some resistance in that area, but I think that our major resistance really comes in at 1938. That's the 23.6% Fibonacci retracement, and it also corresponds to the 50-day moving average. As I said yesterday, when you get two different technical indicators alluding to the same price point, we call that confluence, and that strengthens these calls and gives it a synergistic effect, meaning the whole is greater than the sum of its parts. And that's truly what we're witnessing here. Depending on the jobs report tomorrow, we could see a really strong reaction. Now they're predicting the total of about 850,000 new jobs. They're also talking about a lowering of the unemployment rate from 8.4 to 8.2, but traders realize that does not account in any large manner to the millions of Americans that are currently under or unemployed. And so even with that kind of a robust number, we've got a long way to go. The other issue, of course, is the pandemic. We do see it flatlining. There's no doubt about that, but we have states that are opening up, having no restrictions, such as Florida. And we could see this morph into something more serious. My hope is that the opposite actually happens. Traders, maintain your current long position in Forex gold, gold futures. Let's take a look at silver. Traders, while I am very, very comfortable with the unrealized profits we have gained in our gold positions in Forex and futures, silver has been a different story. Because yesterday we had that sharp decline. You can see that with this large red candle here. And today we had a recovery. Market is trading at 23.92, roughly the price point where we entered. But what does make me feel bullish about silver is that we had a very similar reaction in terms of that 100-day moving average. That was the low that was achieved, I believe, on Thursday of last week or Friday of last week. However, unlike gold, we're not getting that confluence. In other words, these particular prices, at least in terms of the 100-day moving average, certainly not lining up. It's a little different when we look at the price point of the 23% retracement level, because that roughly corresponds with the 50-day moving average. So I am still bullish on silver, but I believe that gold, in terms of its safe haven allure, will outperform silver if in fact it's a safe haven play. To that end, I'm still looking to maintain our long position in silver and to maintain our current stop levels. In terms of the ETFs that we have been trading, they have been moving in a direction where they have made up for yesterday's decline. 178.70 on GLD, roughly where we entered the trade. And then when we look at SLV, that is currently at 22.09. Now, these are much more long-term plays. I don't look at the ETFs in the same way that I look at futures, because with the lack of leverage, these small moves are just incremental in terms of gains or losses in the ETF, and they can be huge in the futures contract. Maintain your ETFs, maintain your futures positions. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for the weekly wrap-up and review. Have a great day. Bye-bye.